Hey guys, Chad Larson, MLD Wealth. It is November 1st. Everyone's got a sore tummy from eating too many Halloween candies, and here we are. So, November update. Let's dive right into it. I'm going to kind of go off script a little bit here. This is probably, if I can get past the nerdy part real quickly, hopefully I can entertain everyone with some pictures at the end of this. We've been talking for months about the fall. Traded very well through the summer, kind of called a lot of things right, from positioning strategies, being overweight energy, and looking for deep value that would align with a more inflationary environment. So our game plan coming out of the fall was that we would likely see a year-end ramp, giving what we called was the extreme whoosh, and what history suggests that following drops of more than 20% in the S&P through September, that sustainability, that rally ultimately depended on interest rates. Last week we saw a 2-year high in the 2-year U.S. Treasury, and that yield reminds us that the S&P low is again continuing to make a low, not the low. And we've been talking about the market creating, trying to find a bottom, but the bottom would likely be signaled when we saw a change in hawkishness, or a change in the speed and cadence at which Federal Reserve Bank and Bank of Canada, et cetera, would continue to raise rates. We saw last week the Bank of Canada came last Wednesday with a 50 basis point hike. Market was expecting 75. I was kind of published in the paper talking about I was a little disappointed at the start, right after the announcement. Kind of thought they would nuke the market a little bit, maybe even go 100 basis points and really ratchet down the economy and try to get this inflation thing dealt with so we can get on to making money. That didn't happen, but I think as I stepped back and thought a little more pragmatically about what the Bank of Canada was doing, and likely what the Federal Reserves are going to be coming out next week with, is you can't academically fix inflation by textbook, and kill the consumer at the same part, nor if they go real fast, real sharp, and then instantly start cutting rates. I think all that will do is kind of throw a wet blanket on the fire of inflation that's burning underneath the economy. And so I think what's going to happen is a little bit of the thesis has changed. I think we're going to see rates slow down, but they still go higher, but kind of stay flat for a while, and then kind of really temper things off and ensure that inflation is dealt with. That being said, we've always talked about a couple things that were leading into our thesis of being overweight cash, being defensively positioned in through the fall. Was that historically September, October are poor times in the marketplace, seasonal weakness, as well as going into a U.S. midterm election, which is next week. And I'll have some charts on that, as I have in the last couple of weeks. So as we continue to find a bottom, we're looking for the bottom. Since 1960, once the S&P 500 has dropped 18%, it's never made the absolute low again, unless we see a minimum 2-week drop in the U.S. Treasury yield. So, a lot more kind of stuff to kind of chime through. I will publish these slides as well. So the real difference between prior bear market lows and now is the Fed's messaging is totally different. So the problem is money and messaging, and our core thesis has always been driven by the availability of money. No matter how many cure-all formulas investors come up with, companies and households cannot spend money they do not have or cannot afford to get. So that's money supply, real liquidity, and the equity capital markets remain largely shut down, with new equity issuance just off the weakest level since the Great Financial Crisis. So the Fed has said they're going to clearly signal to ignore the financial market turmoil until inflation abates. So we got to duck and cover a little bit longer. That being said, I'm getting very excited. I'm probably more frustrated that we get these kind of violent rallies into the bottom, because you feel like you missed something, and deploying money, because we are sitting on a lot of liquidity inside the core portfolio. And I want to get to a point where there's absolute conviction. But just remember, it's only with hindsight will a market bottom ever present itself. But I have to believe, and I think it's pretty safe to say that within an economic cycle, we're somewhere in the U. whether there's a little bit more to come, whether you're wildly bearish, you think there's another 10-15%, sure. Okay. But it's you can't beat down a beaten man that far. It's just, there's been, the S&P's down over 20%, Nasdaq almost 30. Okay, so if it does another 10, so be it. I get it. There's the emotional abatement and kind of despondency to stay invested, but we're professionals and we've been doing this a long time. I'm getting excited about starting to deploy along this U here. So summary, while the above points are typically true in prior cycles, when the market's made the bear market low, the difference now is that the Fed has yet to change its messaging. I have seen some, scuttlebutt or, whisper, online, so to speak, that there's some, I think it was JP, I don't know, but was kind of hinting at that maybe Jerome Powell, or J-Pow as the kids call him, is going to come out and be dovish this, next week. If the Fed, does a small 25 basis point hike, you could see the market, surge 10%. That would probably make me vomit, because I would have wanted to have, deployed more capital. But we do have enough beta exposure on that we'll go for the ride. And as I've explained to many of you many times, we look to construct portfolios that have more upside capture than downside capture, and only during violent periods of market drawdowns has this played testament to how we approach overall risk management and portfolio construction. So the Fed pivot typically comes from a significant deterioration in the economic data and or a market event that is perceived as systemic risk. We haven't seen either. Only then will investors be able to look through the coming economic weakness in the first half of 2023. And that's something, I'm reading a lot of this from our, strategist, Tony Dwyer, who's brilliant. The market's going to be, the news cycle is going to be, houses prices coming down, in some of the overheated markets. Job losses are going to surge. There will be a lot of negative media, at the homeowner, at the kind of the middle class working person level. And I'm not insensitive to that. I'm having to sit here and talk about what I do for a living and how I allocate capital. I'm not insensitive to the fact that many people are going to lose their jobs. Home equity values are likely going to come, retrace back significantly. It's going to cause a lot of pain. But for what I have to do every day is position, a client capital, my own capital, into the marketplace to earn our fair share of market return. That won't bother me. That will be that signaling point where, because the market's a forward-looking vehicle, the minute we start to see a less hawkish or a decelerated tightening cycle, the markets will start to move. We've been talking about the U.S. midterm election, kind of the last few key months overlapping with seasonal weakness. But the next 6 months have been higher, 18 of the past 18 times. Yes, things have been tough so far this year, but be open to better times. What happened in the rearview mirror doesn't mean it'll happen again. And all the investor caveats aside, after kind of here comes the best 6 months of the 4-year presidential cycle. So deploying capital here, yes, you might not be at the bottom, but we're finding a bottom. Deploying capital here is going to make a lot of sense. These are great returns. Remember, most of your market returns in portfolios, they're made in very big chunks and they're lost in very big chunks. That volatility is what's the difference between an equity investor and someone buying treasuries or GICs. Listen, the S&P is still tracking midterm seasonal composite really well. We're looking at 5 days, 10 days, kind of 6 months, kind of forward seasonal composite returns. But here we are, just tracking the last kind of 123 years into midterm election years. So everything seems to be on track. I will talk about the magic 3,900 number later. If not, send me an email on it. We talked about the signaling of the Fed, and it's the bottom will be defined as when the Fed changes their tune, so to speak. And remember, this is just consensus by a whole bunch of economists, and economics is the dead science apparently. But listen, if anyone has been around for the last 3 years, I think there's a lot of other sciences that are dead. Current market expectations for the path of Fed funds rate November expected 75 basis points. December 50 basis points hikes. February a 25 beeps hike, and then a pause. So we've got probably the last hike before things start to taper off. So if the Fed comes out at 50 this time, not 75, it'll probably accelerate this curve and move it. And we'll have to be a little bit more aggressive at deploying capital. But we can tell, like, at this point in the chart is when the market's money starts getting cheaper, flows down to the bottom line. Corporate earnings gives companies the ability to hire more or stop cutting jobs, et cetera, et cetera. We're at near the end of this, which is great. So this is going to be a bullish update. Current bear market is average in duration. We're 284 days into this, but it's a bit shallow in its drawdown. Comparatively to, this is going back to 1929. The median and the average, over a certain, such a lengthy period of time, near 100 years now, has kind of the median drawdown being 33%, and the kind of median duration of a bear market 250 days. So we're longer in duration, we're kind of at the median, we're right in par with the average, a little bit more shallow. So, some people are like, oh, we want to squeak out, we want to wait till the market corrects another 10%. Okay, maybe, but you might miss it too. So we're starting to deploy along the path here. We might not catch the bottom, but we're definitely bouncing along it. The opportunity, this is crazy. At some point, treasuries are so oversold that there's no historical context in the last 47 years to compare what is happening. Eventually, we will probably see a big rally in U.S. sovereign duration, but from what price level is anyone's guess at this point. Basically, like, the 30-year treasury has been murdered so bad, you gotta, at some point, we'll be buying, U.S. treasury. The yield curve's been so inverted, and they've performed so poorly that there might be a big opportunity there. And I remember that kind of during kind of early pandemic part, is you could hide in 30-year treasuries because there was that flight to quality. I don't necessarily think there's a flight to quality, and we have to battle the dollar index, which has gone, top right this year, which will become an actual headwind for corporate earnings. But that being said, it's pretty wild to see how poor treasuries have done. Another bullish sentiment, this is the 3,900 level, so I can't really zoom in here, but this was published October 21st, about 10 days ago. So a lot of nerdy stuff, positive RSI divergence on the weekly S&P. So the weekly S&P made a new low, while weekly RSI made a new high. This is positive divergence, has historically preceded meaningful S&P reversals. So basically, down, rocket ship, down, rocket ship, down. Do we get a rocket ship? I'll tell you right now, the S&P is, I can look here right now, 3855. 3,900 is this magic level. It was a magic level that had been holding in really well, that broke and broke again. So what looked to be support that we broke a while ago is now looking like resistance. And if you're a tea leaf reader, if you're technical, and I'm not teasing technical people, I think the blend of all styles, fundamentals, technical, bottom up, RSI, momentum, they all make sense in fact, confirming an investment thesis. But that's going to be a pretty interesting number. 3,900 is probably going to be included somewhere in my password scheme for the next couple of years, because if we keep banking our heads against it, it's lower for longer, and we've probably got we're going to get that 10% down that we're all waiting for. But if we crack through that 3,900, it's probably going top right pretty effectively. And I do think it'll be Jay Powell's announcement next week that signals that. So 3,900, we'll talk about it next month. Another positive thing, these are negative charts, but when people panic and start jumping out and throwing the baby out with the bathwater and all the proverbial things that are probably politically incorrect at this point, but margin debt is off the record highs set last year, and the speed of the deleveraging suggests absolute excessive investor pessimism. Reversals from these extremes, which we have not seen yet, have been followed by above average gains 18 months later. Again, a positive data point and reconfirming that we're probably through the worst of this here. Something to watch. Listen, we've seen a large flight to quality and been able to pick away and not have to play in some of these wildly valued hyper growth companies. This is more David than Goliath investing because there's a lot of incredible companies that don't get the fanfare. But don't forget small caps. They have a place in investor portfolios. Small caps have outperformed large caps coming out of recession 6 of the last 6 times. And that's all that data that we have on an average by an additional 14% through the trough. So yes, it's far easier, far more liquid, far more pragmatic to be kind of shopping in the value bin, things that are on sale. That being said, we'll continue to recommend a component of exposure to small caps because there's absolutely no price discovery. There's so much tax loss, rotational trading that we have to do here. We've paid a lot of tax in the last couple of years. Any investor has to be selling things they're down on. So that's the case. And listen, small caps are cheap in times when valuations really matter relative to the S&P. The Russell 2000 is trading as low as it did in the post-dot-com bubble. Another positive, Bank of America's latest survey of consumer expectations said investors are screaming capitulation. I love that word. With cash levels of 6.3%, the highest since April of 2001. These are broad measurements, the entire U.S. kind of investor base. And investors 3 standard deviations underweight equities. This report also showed global growth expectations of minus 72% near record lows, while investors have started to increasingly expect the monetary policy capitulation, with the most investors since November of 2008 expecting lower bond yields over the next 4 quarters. This reflects significantly depressed positioning on sentiment. Morgan Stanley's Mike Wilson, who's one of the most bearish strategies, said this week he sees a short-term technical rally after the market tested that 200-week average. And JP Morgan's survey this week also showed equity exposure at a record low. So listen, anytime people are caught off guard and they're not owning equities, things tend to surge on the back of that. That's all I have for you guys today. Again, if there's any questions or comments, feel free to give myself or any member of MLD a call. Have a wonderful month, and we will talk all soon. Take care.